Welcome back to the deep dive. Today, we are wrestling with a topic that is mathematically dense for sure, but absolutely critical for understanding, well, the future of money. We're talking about the Federal Reserve's balance sheet.
Yeah, it's this mountain of assets that it's grown so large so quickly that its very existence has completely reshaped our banking system.
So our mission today is to cut through all the jargon, the SOMA portfolios and the IORB, and explain exactly why this asset pile isn't just massive, but, well, functionally permanent. Okay, let's unpack this.
It's a great topic because we had a listener ask for a really rigorous look at how the Fed's assets evolved, specifically that system open market account, the SOMA portfolio, and to really confront that question, is it permanent?
And what we're looking at, it's a financial transformation that should shock anyone who remembers how central banks used to work.
It really should.
Shocking is the word. I mean, we have to start with the scale, just the sheer numbers. Before the great financial crisis in 2008, what was the Fed's balance sheet?
Well, it was about $900 billion.
Yeah.
It was, a footnote.
A total footnote.
Yeah.
And today, as of what, December 2025, where are we?
We're looking at approximately $6.56 trillion.
That's trillion with a T.
And that's after 2 years of them trying, really desperately to shrink it. It peaked at nearly $9 trillion back in 2022.
That's a tenfold expansion. It's hard to visualize.
It is. Imagine your local fire department had one truck, then bought 10 more for a big fire, and now they can't sell any of them. They're all just parked there.
Which leads us right to our core thesis, this whole idea of a financial Hotel California.
Exactly. It's easy to check in, impossible to check out. This huge size is no longer an emergency tool.
Right. It's a permanent structural feature, this $6.5 trillion floor that I think seriously hampers the Fed's ability to respond to whatever comes next.
And to understand why it has to be so large now, we really have to look under the hood. At the monetary plumbing, this shift from what was called scarce reserves to ample reserves.
Okay, so take us back. Tell us about the old system.
The old system, so pre-2008, was lean. It was efficient. The reserves, that's the cash commercial banks, hold at the Fed. They were intentionally kept scarce. We're talking maybe $10 to $15 billion for the entire U.S. financial system.
Yeah, it's nothing.
It's nothing. And because it was scarce, the Fed could control interest rates, the Fed funds rate, with really small surgical operations. A few $100 million here or there could move the market.
So it was a scalpel.
It was a scalpel. But after 2008, the crisis-era liquidity injections, they just completely destroyed that scarcity. Reserves flooded the system, surged into the trillions. The old mechanism just broke.
Because you can't target scarcity when you have an overwhelming supply.
Precisely. And that forced the switch to what we now call the floor system. It relies on this perpetual oversupply of reserves.
An oversupply that's currently what?
We're talking somewhere near $3 trillion.
Right.
And the Fed now controls interest rates, not by tweaking the supply, but by paying interest on reserve balances, the IORB.
Okay, so think of the IORB as a risk-free rate for banks. Why would I lend money to anyone else for less than what the Fed guarantees me for just parking my cash?
You wouldn't. That's the point.
Yep.
It sets a floor for the entire short-term rate market.
Right.
And here's the key insight. This floor system requires a permanently large balance sheet to make sure reserves never, ever dip back towards scarcity. And on top of that, you have post-crisis regulations like the liquidity coverage ratio.
Which forced banks to hold tons of high-quality liquid assets.
Exactly. And reserves are the highest quality asset. So the banks themselves now demand trillions in reserves just to operate safely. The Dallas Fed estimates that number is around $3 trillion. That structural need, that locks in the size of the Fed's portfolio.
So the monster can't shrink because the whole system has been rebuilt around it. It's become load-bearing. Okay, let's track how it got this big. It happened in 3 massive waves, didn't it?
It did. Wave 1 was the immediate crisis response, 2008 to 2010. The balance sheet just rocketed from $900 billion to about $2.3 trillion. That was QE1.
Right, quantitative easing 1. And that was sold as an emergency measure.
It was. But it institutionalized the purchase of long-term assets, including a staggering $1.25 trillion in mortgage-backed securities, or MBS.
And then came the second wave, where QE stopped being just an emergency tool and became, well, just policy.
That's right. From 2010 to 2014, we had QE2 and then the open-ended QE3, which people started calling QE infinite.
QE infinite, I remember that.
That's when the balance sheet just grew and grew up to $4.5 trillion. And the significance here is that it cemented this multi-trillion-dollar portfolio as the new normal. even when there wasn't an acute crisis happening.
And then the third wave, the one that dwarfed everything before it, COVID-19.
Yeah, the hyper-expansion. It was the most aggressive period in Fed history. The balance sheet doubles from $4.2 trillion to its peak of nearly $9 trillion in just a matter of months.
And they were just vacuuming up assets.
$80 billion in treasuries and $40 billion in MBS
Yeah.
every single month. They were essentially absorbing the massive fiscal deficits from the government.
So you see this undeniable pattern. Each crisis doubles the baseline. The old peak just becomes the new floor.
And that last expansion created a huge composition problem. This brings us to the trap. The $2.05 trillion in those mortgage-backed securities.
This is where we get back to that Hotel California idea, or as some people call them, roach motel assets.
That's a good way to put it. Normally, when the Fed buys MBS, they expect them to roll off the balance sheet pretty quickly as people refinance their homes or move.
But the Fed spent 2022 and 2023 aggressively hiking interest rates.
Exactly. So now you have millions of homeowners with these amazing 3% mortgages. They are not, under any circumstances, refinancing into a 7% mortgage.
So prepayments, the natural way these bonds expire, have just frozen.
Frozen solid. The natural runoff has slowed to a crawl way below the $35 billion monthly cap the Fed set for itself. And this creates something called duration extension risk. It means the expected life of those bonds, which was supposed to be maybe 5 or 7 years, now stretches out towards the full 30-year term of the mortgage.
So they're stuck with them for decades. They really are roach motel assets. They check in during a crisis, but they never, ever check out.
That's the trap.
So what about quantitative tightening, or QT? That was the big plan to fix all of this, right?
That was the plan. It started in June 2022 with a really ambitious target. Let $95 billion a month roll off the books. $60 billion in treasuries, $35 billion in MBS.
The goal was to aggressively get back to some kind of normal. And the reality...
Ultimately fell way short.
Yeah.
I mean, the total reduction was only $2.4 trillion from that $9 trillion peak. It left us right where we are at $6.56 trillion.
And they had to slow it down, didn't they?
They did. By mid-2024, they had to taper the pace, cutting the treasury runoff from $60 billion down to $25 billion a month. And then just recently, in December 2025, they officially terminated the whole program.
The end of QT. That confirms it. The $6.5 trillion floor is here to stay. Why did they pivot so hard?
In a word, fear. They are structurally terrified of liquidity stress. You have to remember the shadow of September 2019.
The repo crisis.
Right, when the SOFR rate, a key overnight lending rate, just spiked by 300 basis points in an afternoon.
Yeah.
It was a heart attack in the plumbing of the financial system.
A flashing red light that they had gone too far, too fast, and they were about to break something.
Exactly. And they are so fixated on avoiding a repeat of 2019 that they will always, always choose system stability over balance sheet size. We just saw them eliminate the $500 billion daily limit on their repo facility. They're basically saying, we will inject unlimited cash before we let that happen again.
So the goal of shrinking the monster is it's overridden by the need to avoid a panic. And this has all come at a spectacular financial cost to the Fed itself.
It's unprecedented. The rapid rate hikes completely decimated the market value of the trillions in low-rate bonds they bought.
Which created this staggering paper loss. What's the current number for the unrealized losses on the Soma portfolio?
Right now, the Fed is carrying approximately $927.5 billion in unrealized losses.
$927 billion. To put that in context, what's the Fed's capital base?
It's only about $45.5 billion. The losses are 20 times their capital. If it were a commercial bank, it would be deeply, deeply insolvent.
So why isn't this a bigger panic? The central bank is insolvent on paper.
Because the Fed can't truly go bankrupt, right? It can print money. But these losses have a very real, immediate fiscal impact. It's something called a deferred asset.
Okay, explain the deferred asset. It sounds like an accounting trick.
It sort of is. It's a massive IOU the Fed holds on its own books. Because the interest they pay out to banks on reserves is now way higher than the interest they earn on their old bonds.
They're losing money every day.
They're bleeding money. And that cumulative loss is tracked as this deferred asset, which they have to earn back before they can send any profits to the U.S. Treasury.
And that IOU is currently how big?
It stands at $242 billion. Remember, the Fed used to send about $75 billion a year to the Treasury, which helped offset the national debt.
Now they send zero.
Now they send zero. The central bank, which is fighting inflation with high rates, is now financially bleeding because of its own high rates. It's an incredible irony.
And this all boils down to the most alarming part: diminished ammunition for the next crisis. The policy is just fundamentally asymmetric, isn't it?
It is. It's a ratchet. It clicks up in months during a crisis, but it can't click down. It takes decades, if it ever happens at all.
Think about the capacity they've burned through. In 2008, they could 5x their balance sheet.
Right, from $900 billion to $4.5 trillion. In 2020, they could only double it, from $4.2 to $9 trillion. They used up half their runway.
So the next crisis, and we know there will be a next crisis, if it requires that kind of intervention, we're talking about a balance sheet of 12 trillion, 16 trillion.
It could easily be. And at that scale, say $16 trillion, the Fed would own the vast majority of all outstanding U.S. Treasury debt.
Which is basically the socialization of credit.
That's what it is. The central bank, not the market, becomes the ultimate decider of the cost of capital in the U.S.
And this creates this massive moral hazard problem, this idea of the Fed put. The market just assumes the Fed will bail everyone out.
It's an assumption that's been proven correct time and time again. It encourages huge risk-taking everywhere because everyone knows the ultimate safety net is there and it's permanent.
So if we connect all this to the bigger picture, this 6.5 trillion balance sheet, it really is the floor. It's the minimum needed because the entire financial system has been rebuilt around it.
It has. And you can look internationally to see where this path leads. The U.S. Fed is at about, 22% of GDP? It sounds like a lot.
Until you look at Japan.
Until you look at the Bank of Japan, the pioneer of all this. The BOJ's balance sheet is a staggering 105 to 125% of Japan's entire GDP.
We're not there yet, but the warning is clear. You expand aggressively in a crisis, and then you find it's technically and politically impossible to go back.
And this bloating makes the Fed incredibly vulnerable politically. When you hold trillions in government debt, critics, they start to argue you're blurring the line between monetary and fiscal policy.
The charge of fiscal dominance, that the Fed is just there to help the government finance its debt cheaply.
Which is why you see things like the Federal Reserve Transparency Act getting more attention. The bigger this monster gets, the more people want to look over its shoulder, and the more the Fed's independence is at risk.
So what does this all mean? Quantitative tightening officially ended in December 2025. The reversal confirms the Fed is locked into a balance sheet nearly 10 times its historical size.
The core problem is that asymmetry. It can be built in a few months of panic. But the structure, the trapped assets, the political fear, it means it can't be unwound in decades. The 6.5 trillion floor is the new reality.
And this structural change is maybe the biggest new weakness in the entire dollar system. What happens when the next crisis hits and the Fed is already trying to manage almost $1 trillion in paper losses, trying to avoid a liquidity panic, and then it has to somehow double its balance sheet again?
The capacity just isn't what it used to be.
The Fed built a $9 trillion monster to save the economy. Now the monster lives in the basement and nobody knows how to make it leave.